Okay, welcome to our first Food and Finance Friday segment. We're excited to have you here today. My name is Rachel Gustafson and I am joined by Brittany Jacobson. We are going to be guiding you through our webinar today. So we are going to be hosting these weekly on Fridays at noon, presenting different financial topics that impact you and even inviting specialists in different fields to join us. So at the end of our session today, we're going to be having you vote on your preferred times. We chose 12. It seemed like an easy time when it might be a lunchtime for you, and hopefully you're able to get away from your office or home and take some time to learn about finance. But if there is a different time that's better for you, we are going to have a time to vote at the very end. We also are going to be inviting you to complete a survey to let us know if there are certain topics that you want us to cover. For this first couple of weeks, we're actually going to be focusing on Social Security. So today we're going to talk about the changes for 2020. Next week, we're going to be talking specifically about planning, Social Security planning for couples. And we're also going to be doing a presentation on Medicare, where we're going to bring in a healthcare specialist to talk about Medicare options and things to be thinking about. So that's a little bit about our Food and Finance Friday that we're going to be doing. A little bit about Financial Investment Team. So we are a woman-owned and run firm. We specialize in holistic financial planning and financial education. All of the planners in our office are certified financial planners. So if you aren't familiar with the designation, we went through extensive training and experience requirements, and we committed to the CFP board's ethical standards. These require us to put our clients' interests first. No matter your financial situation, we meet you where you are at and help you make your money work harder for you. Who doesn't want that? Everyone deserves peace of mind in their finances. So just a little bit about us on the screen here. Next week, we plan to be on video so you can actually see us. We're just working through some technology. But today we're going to be spending some time talking about what's new in Social Security this year and what it might mean for you. So I'm going to do a quick poll question here and just ask, have you started drawing on Social Security? This is just going to give me an idea of who we have on the call today, if you're planning for Social Security or if you've already started collecting Social Security. All right, so it looks like 67% of us have not started taking Social Security and about 33% of us have, which is great. You'll find today's information helpful on both ends. Okay, so here are the topics that we're going to be touching on today. Social Security's cost of living adjustment, the 2020 earnings test, Social Security taxes, Medicare premiums, Medicare dates to watch. We'll go into some simples there. And the status of the Social Security Trust Fund. This is a question that we often get asked about. We're also going to talk about some changes to claiming strategies. Cost of living adjustment. So this is where we're going to start, or COLA in short. This is the increase that Social Security gives to everyone each year to try and keep up with inflation. So in October every year, the Social Security Administration announces a bunch of numbers that are determined by the rate of inflation over the last 12 months. The most eagerly awaited number is this cost of living adjustment, or the amount by which Social Security checks will be raised. Another number is the new earnings test threshold, which we're going to talk about too. So the cost of living adjustment for 2020 is 1.6%. So you're going to see your checks, if you're collecting it, you're going to see them increase. And even if you're not collecting Social Security, your benefit will increase by this amount. So it's down from 2.8% in 2019, but essentially it means that if, for example, your current benefit is this $800, you'll see an increase of $12.80. So your new benefit amount each month will be this $812.80. The higher your benefit is, so if you look at the bottom of the graph here, the higher your cost of living adjustment is going to be. So if your benefit is $3,300, which could happen if you're a maximum earner and you claimed your benefit at age 70, you'll be getting a cost of living adjustment of $52.80, bringing your total benefit to $3,352.80. Now, here's the kicker. If you're enrolled in Medicare and having your Medicare premium taken out of your Social Security check, you may not see this much of an increase. Part of your cost of living adjustment may be absorbed by the Medicare premiums. So we're going to talk about the Medicare premiums in a little bit, but it can be often very confusing for people. Well, where was my cost of living adjustment? It may have gone to your Medicare premiums. Let's put the cost of living adjustment in perspective. So you can see here what it was since 1985. Inflation has been low over the last few years, so it has been pretty low. Going back to 1985, the average has been 2.6%. Social Security trustees project a 2.6% COLA going forward, although this year was smaller than that, and we'll talk about how that's calculated. So the cost of living adjustment is based on the Consumer Price Index for all urban wage earners. The Consumer Price Index measures the change in a basket of goods and services that a typical urban worker might buy. So it covers things like food, transportation, housing, entertainment, healthcare, pretty much everything that people spend money on. In any case, COLA is announced each year in October, and it takes effect with the Social Security checks you start to receive in January of that next year. Even if, as I had mentioned before, even if you haven't started your Social Security yet, let's say you're delaying it until age 70 to get a higher amount, your benefit will still be raised by the COLA every year. Okay, so that was the cost of living adjustment, the amount that your checks will be increasing for this year. The next big change that we're going to talk about is the earnings test. And the earnings test can get a little bit confusing. It's affected by the cost of living adjustment. And what it is when you are under full retirement age, and if you're working and you're receiving Social Security benefits, part of your benefit may be withheld. So for example, if you claim benefits at age, let's say 62, your full retirement age according to Social Security is 66, you have technically taken your benefit 4 years earlier than your full retirement age, or FRA, as we say. So you're subject to this earnings test. Social Security will withhold $1 for every $2 you earn over the threshold, which went up this year to $18,240. Last year it was $17,640. So as long as you earn less than $18,240, none of your benefits will be withheld. But I would just like to comment that trying to earn less money is not exactly a formula for wealth building. So if you're under full retirement age and you have the opportunity and ability to work, probably better to earn as much as you can and delay applying for Social Security. The new threshold for the year you turn full retirement age is $48,600, and that's up from $46,920 last year. This higher threshold comes into play if you were receiving Social Security last year and you turned full retirement age in 2020. In the months leading up to your full retirement age month, $1 in benefits will be withheld for every $3 you earn over $48,600. But once you turn full retirement age, no benefits will be withheld. This earnings test only applies before you reach full retirement age. So it's really important to just understand that. We actually have a program that we can plug in. Okay, how much are you going to be making? How much in Social Security will you be receiving? And will you be subject to the earnings test, and about how much will it reduce your Social Security? That can be a helpful tool that we can go through. So while we're on the earnings test, I'm going to take a moment to explain the monthly earnings test to make it even more confusing. You know, things can't be super simple. This comes into play the first year you apply for Social Security benefits. So let's say you are under full retirement age, you file for Social Security this year, and you're continuing to work. If you earn more than $1,520 in any month, your benefit will be withheld. The next year, you will be subject to the regular earnings test, that 18,240 that I mentioned. So if you earn even $1 over that 1,520, that $1,520, then your benefit will be withheld for that month. So there's this monthly earnings test, and it really only applies in that first year that you file for Social Security. And when I say withheld, I often get asked the question, well, if they're withholding my Social Security, where is that going? Well, once you turn full retirement age, whatever amount that was withheld will get prorated over your life expectancy for Social Security. So for example, if you had $10,000 withheld before full retirement age, you turn full retirement age, that $10,000 is going to get prorated over your life expectancy. And let's just say it's 20 years. So $10,000 over 20 years will get added back in. It's not going to be a huge increase. You might see a little bit of a bump, but if it's prorated over that 20 years, it's not going to be as big as you might think. But you do get it back when you turn full retirement age. Generally, our recommendation is to wait until you stop working to apply for Social Security, so you don't have to deal with this earnings test. But there may be exceptions. Every situation is a little bit different, and so it really depends on you and what you need and what makes sense for you. So I want to make sure that this hits home. So I have a quick question for you. And it is, when does the earnings test affect you? I'll give you just a second to answer that. When you start drawing on Social Security, before full retirement age, or always? Okay. So the answer is before full retirement age. The earnings test only applies to you before full retirement age. Once you turn full retirement age, you're no longer subject to the earnings test. It can be a very confusing topic. This is why we always bring it up and we always do planning around it. Okay. So we've said everything about the cost of living adjustment, the earnings test. Next, we're going to take just a moment to talk about payroll taxes. So payroll taxes, when you look at your pay stub, you see them taken out of your check, and you may be wondering, well, what exactly is that? That's your contribution to Social Security and Medicare. But so Social Security tax went up to $137,700, the earnings that it's subject to. So for example, let's say that you earned $150,000 this year. You're only paying Social Security tax up to $137,700. Any income that you earn beyond that, you're not going to be subject to the Social Security tax. So this means that higher earners will pay Social Security taxes on more of their earnings. But remember, Social Security taxes represent a pretty good investment in the form of inflation-adjusted income that is meant to last for life. The more earnings you have, the more Social Security taxes you pay, the higher your benefit will be. And remember, as long as you're working and paying into Social Security, your benefit will continue to be adjusted. So if you improve your earnings record, your benefit may go up, even if you already started collecting. And just as a reminder, Social Security looks at your 35 highest earning years to calculate your benefit. And so if you look at your earnings history and you see that you have 30 years, but 5 years have not reflected any income, those 5 years are going to get zeros. So if you have an opportunity to work a few extra years and get some more income into those 0 years, it's going to increase your benefit. Social Security tax rate did not change. So as an employee, you are paying 6.2% in payroll taxes on your earnings. Your employer will pay the same amount. If you're self-employed, you will pay both parts for a total of 12.4%. The Medicare tax didn't change either. The employee's portion is 1.45%, and self-employed people pay both sides, so 2.9%. So if you're an employee, you're paying that half mark, and your employer's taking care of the other half. If you're self-employed, you're paying all. So let's look at the math on this. If you earn that maximum of $137,700 in 2020, you will pay about $8,537 in Social Security taxes. If you're self-employed, it's double, $17,075. And then the Medicare tax will be on top of that. So I have another quick question for us. Is Social Security taxed? I promise it's not too much of a trick question. And it looks like most of us see Social Security can be taxed, I guess I should say. We're going to talk about that. Taxation of Social Security benefits. What does that look like? We often get asked this question as well. Well, I didn't think my Social Security benefits were taxed. Well, they can be. Ever since 1984, Social Security benefits have been subject to some level of taxation depending on your other income. And so this table shows the taxation of Social Security benefits based on the various income levels. So income in this case is this provisional income, adjusted gross income, plus half of your Social Security benefit, plus any tax exempt interest that you earned. And so that gets added back in, and that is your provisional income. If your provisional income is under $32,000, if you're married filing jointly, then your Social Security is not subject to tax. If your provisional income is between this $32,000 and $44,000, up to 50% of your Social Security subject to tax. If it's over this $44,000, up to 85% of your Social Security is subject to tax. So I like to note these income thresholds, they may seem pretty low. Well, they were never adjusted for inflation. So more and more people are having to pay income taxes on their Social Security benefit. The important thing to remember is that up to 85% of your Social Security benefit may be subject to tax, depending on how much your other income is. And this is part of a really important piece of Social Security planning and retirement planning, is looking at where's your income coming from. Are you going to be subject to tax, and preparing for that, and possibly reducing if we can. So the next topic that we want to touch on is required minimum distributions, or RMDs for short. So you may have had your income and tax situation all figured out, and then you have to start taking your required minimum distributions from your IRA. If you don't plan ahead, these RMDs can actually bump you into a higher tax bracket. In addition to having to pay the income tax on the RMDs, it might also cause you to pay more tax on your Social Security benefit. So the law recently changed with regard to these RMDs. The minimum age was raised to 72. It used to be 70 and a half. So if you'll be turning 70 and a half, or if you did before December 31st, 2019, you'll be under the new rule. Or after December 31st, 2019, you'll be under the new rule. And you can start your RMDs at age 72. If you were already 70 and a half at the end of 2019, you're still under the old rules and have probably already taken your RMD for 2019, unless it was your first year and you decided to defer. This year with the CARES Act, you can, if you were required to take an RMD this year, you don't have to take it for 2020. That was part of the CARES Act just for this year. But normally it's going to be age 72 that you have to take a required minimum distribution. The IRS calculates that for you and tells you what it is. So what we want you to come away from here is it's really important to plan for Social Security taxes ahead of time. Those of you who are still well in advance of that 72nd birthday might want to start drawing down on those assets so the RMDs don't force you into a higher tax bracket for Social Security. Operative word here is might. Beating the Social Security tax might not be worth it, pending other tax considerations. So really important to talk to your tax advisor and your financial planner to see what makes sense for you. You could also potentially look at a Roth conversion, which generates tax-free income and isn't subject to that RMD. Again, you want to talk to your tax advisor and financial planner and make sure it makes sense for you. But these are some strategies that we use for clients if it makes sense. The other way to pay less in Social Security is to delay it. Reducing the number of years your income is subject to tax. This is not the main reason to delay benefits. Delaying Social Security benefits is mostly advantageous because of the higher benefit you're going to get, but it can also help with your tax situation. We're going to talk about new legislation. The big legislative news at the end of 2019 was the passage of the Secure Act. Some of you may have sat in on the Secure Act webinar that we did, but this sweeping legislation has a lot of provisions, but the ones that are most likely to affect people here are these. Number one, RMDs can now be taken at age 72. I just mentioned that. Number two, if you are over 70 and a half and have earned income, you can now contribute to an IRA. It used to be that you couldn't contribute to an IRA after age 70 and a half. But now that people are living and working longer, IRA contributions are allowed after that age. This opens up some interesting strategies that we can talk about privately if you're interested. The third is inherited IRAs must now be drained by the end of the 10th year. So it used to be that if you were leaving your IRA to your beneficiaries, they could stretch them out over their lifetime to defer taxes. But the government says no more, except in the case of spouses and a few other exceptions. So IRA beneficiaries must take and pay taxes on the entire IRA by the end of the 10th year. And so this has really changed some of the retirement planning that we do with our clients. Again, if you have more questions on this, schedule a time with us and we'll chat about it. We also want to mention the Tax Cuts and Jobs Act of 2017. Took effect in 2018 and it's been around for 2 years, but people are still getting used to the new rates and standard deductions. So you may want to continue to fine tune your withholding or estimated taxes for 2020. As always, talk to your tax advisor, talk to your financial planner, and see what makes sense for you. Following today's webinar, we are going to offer a complimentary Social Security check-in. We can actually run an analysis to help you determine when's the best time for you to take Social Security, what different scenarios might look at if you have questions. So, we have some really great software that really is great about showing you the differences at different ages. So now I'm going to introduce Brittany Jacobson. She's going to jump into Medicare. Brittany, I'll pass it off to you.
Awesome. Thank you, Rachel. So like Rachel had said, we're going to just move right into how Medicare premiums have changed. First of all, the base Part B premium is now $144.60 a month. Some people will end up paying more than this due to the income-related monthly adjustment amount, or IRMAA. If you're on Social Security and you have your Medicare Part B premium deducted from your Social Security benefit, there is a hold harmless provision that keeps your check from going down if the Social Security COLA, or cost of living adjustment, doesn't cover the rise in the Part B premium. So for example, this happened in 2017, where the Medicare Part B premium jumped from $121.80 to $134, which was a 10% increase. But the Social Security COLA only increased by 0.3%. So the few dollars that you got for the COLA didn't end up covering the premium increase, so their premium was left at $121.80 plus whatever the COLA amount was. Some people's premium was even lower than that because they had been held harmless in prior years. This year, the Social Security COLA was 1.6, while the Medicare Part B premium went up by $9.10. This means that for most people, the COLA more than covered the increase in premiums. A few people who got very low COLAs because their benefits are very low may end up paying less than the full $144.60 premium. So the real issue that will be affecting more people is the income-related monthly adjustment amount, or IRMAA, applied to the Medicare premiums. The IRMAA is an extra premium that you have to pay if your modified adjusted gross income exceeds certain thresholds. So starting this year, the thresholds are going to be adjusted for inflation. The first threshold is $87,000 if you're single or married filing separately, which is up from $85,000 last year. For married couples, the first threshold is $174,000, up from $170,000 last year. And for Social Security purposes, the modified adjusted gross income is your regular AGI plus any tax-exempt interest. So like municipal bond interest, for example, would be added to this. Your premium each year is based on the tax return you filed 2 years ago. So if you're on Medicare, your 2020 premium is based on the income you reported in 2018. But if your income has changed due to a specific life-changing event, such as retirement, then you can appeal. So in other words, if you reported a high income in 2018 and you've since retired, go ahead and try to appeal that higher premium. And please note that any one-time capital gain is not grounds for appeal, it has to be earned income. So just kind of keep that in mind. If your 2018 tax return shows high income because you sold an asset in that year, you still have to pay the higher premium in 2020. But if your income has gone back down in 2019, then your 2021 premium will be lower. And then as I kind of briefly mentioned a little bit, the income thresholds are now going to be adjusted for inflation, which was not the case in previous years. So this table shows the Part B and Part D premiums for the different income levels. So if you're in single or married filing separately and your income is under $87,000, or if you're married filing jointly and your income is under $174,000, then you just pay the regular Part B premium of $144.60. There will be no income related adjustment, and then your Part D premium will vary. But if you pick a plan that charges the average premium, you'll pay about $40 per month. And so that brings your total to $184.60 for both Part B and Part D coverage. If, however, your income falls into one of the other tiers, you'll pay an income-related adjustment on top of the base premium. So for example, if you're in the second tier, you'll pay an extra $57.80 for your Part B and an extra $12.20 for your Part D on top of the regular premiums. So that brings your total to $254.60. Now keep in mind that these are per person. So while they're looking at your income jointly, if you're married, they are going to assess that $254.60 for each of the spouses. Your tax return, again, from 2 years ago is used to determine the income-related adjustment. And so for 2020, the tax return in 2018 is what they're using. And then also, keep in mind that the premiums shown here are just for Medicare Part B and D. It does not include any premiums for any Medicare Advantage plans or supplement plans. Okay, so whether you're already on Medicare or getting ready to start it, there are some important dates that you have to pay attention to, so that's what we're going to jump into next. So we've actually already passed these dates, January 1st through March 31st, but it also pertains to every year. So these will be important next year in 2021. The Medicare Advantage disenrollment period is from January 1st to March 31st. During this time, you can get out of a Medicare Advantage plan and go back to original Medicare if you choose. But do make sure that you get supplemental coverage of some sort. If you're going to go back to the original Medicare, you want to make sure that you can cover the gaps with a Medigap policy. But unless you're applying during the Medigap open enrollment period, which is generally the first 6 months after enrolling in Part B, then they don't have to take you. So if you have any health issues or you drop your Medicare Advantage plan, you might not be able to get a Medigap policy. So just make sure that you get everything lined up before you drop any Medicare Advantage plan. The second thing that's important within this date, January 1st through March 31st, is the Medicare general enrollment period. So this is for people who have never signed up for Medicare when they turn 65 or left their employer. And so if you do sign up for Medicare during this time, your coverage will start July 1st. A couple other dates that actually do pertain to 2020 at this point. October 15th through December 7th is the annual open enrollment period for people on Medicare. In September, you'll receive information from your current plan about their offerings for the next year. Pay attention to this. Your premiums might be going up, the coverage might change, or maybe there's new plans in your area. So if you currently have a Medicare Advantage plan, you'll want to see how it's changed for the next year. If you have original Medicare, you'll want to see how your drug plan will change next year. And then you'll want to look at other plans offered in your area to see if any of them might be better than the current one you have. If so, you want to make sure to contact your current plan by December 7th and let them know. If you don't, and you do nothing, then you will be re-enrolled in your current plan for another year. So although you have another chance to switch out during that disenrollment period I just talked about from January 1st to March 31st, it's much more efficient and easier for you to just make your choice during open enrollment. And so you don't have to worry about messing up with your plan during the calendar year. Okay, so lastly, we're going to talk about the future of Social Security. Social Security was designed as a pay-as-you-go system. So payroll taxes from current workers go into a trust and are immediately paid out to current retirees. Baby boomers have been at their peak earning years. The trust fund has accumulated more than needed for current benefits. Right now, the trust fund holds about $2.9 trillion, which is invested in special issue treasury securities. But the problem is, as baby boomers start retiring, these trust fund assets will gradually be drawn down. Over the next 75 years, costs will begin to exceed income. There are enough reserves that the system will be able to pay 100% of promised benefits until 2035, which is only 15 years from now. After that, if nothing is done to reform the system, income will only be sufficient to cover 80% of promised benefits. So although the Social Security system is not an imminent danger, most people agree that the earlier reforms are instituted, the less painful they will be on everyone. Really just a math problem that involves an increase in revenues or a cut in benefits or a combination of the two. So this slide shows a couple of the ideas that have been proposed. The first one is to increase the maximum earnings subject to Social Security tax. So as Rachel had mentioned, it's currently at $137,700 in earnings that are subject to that 6.2% tax paid by you and your employer. One way to shore up the system is to raise the earnings cap or just eliminate it altogether. So they could raise it to $150,000 or just get rid of it, and anyone, you make $300,000, they'll still tax it. Another reform proposal calls for raising the normal retirement age. Currently, full retirement age is age 66 for anyone born between 1943 and 1954. It's 67 if you were born 1960 or later. And if you're born between 1954 and 1960, it's 66 and some number of months. An argument in favor of raising retirement age that people are just living longer in general. But an argument against it is that some people whose occupations involved hard physical labor can't really work until age 70 or later than that. Still, another reform proposal would change the benefit formula altogether so that future increases would happen at a slower pace. This would affect the benefits of all future retirees, however. And then some are also talking about changing the formula for the cost of living adjustment. And this could give retirees smaller benefit increases going forward, although the changes are expected to be minimal. Given that there are a lot of ways the Social Security system can be reformed, is Congress likely to address the issue this year? Some say now that the Democrats have a majority in the House, they may get around to acting on a previous proposal introduced by Representative John Larson. This proposal would make several changes to the system, both raising benefits and raising taxes. Benefits for current retirees would not be affected, except that the COLA would be based on the new index that measures inflation for the elderly. That is, it would take into account the things retirees tend to spend money on, like healthcare, so it would presumably be an improvement. If passed, the proposal would restore full solvency to the system over the next 75 years. But as we kind of talked about, 2035 is the target date that 100% of benefits are going to last. And this is going to be a proposal that would take 75 years. So there's still going to be a time gap where we're not really sure what to do about Social Security. Okay, so to finish up, I'd like to talk a little bit about some of the Social Security claiming strategies, even though many might not affect you, especially those of you who have already started taking Social Security. So some of you might have heard about file and suspend. To refresh, it's one where the higher earning spouse files for their benefits, and then they immediately suspend them. And then because he's opened his record, the lower earning spouse can claim a spousal benefit, which is 50% of the higher earning spouse's benefit. The Budget Act passed in November of 2015 disallowed certain spousal claiming strategies, and this was one of them. So as of April 2016, you can no longer use this option. Unless you placed your suspension before that date, your spouse will not be able to claim a spousal benefit this way. If you did happen to suspend before that deadline, then it's mostly a question of making sure your spouse takes their spousal benefit at the optimal time if they haven't already tried. Other than that, it's basically a question of sitting back and waiting. Your benefit will automatically resume at age 70. The other strategy, claim now, claim more later, is more important. If you're born before January 2nd, 1954, you're grandfathered in for a key strategy, which could potentially shore up your retirement. Remember, it's not generally possible to take a benefit based on your spouse's record if your own benefit is higher. But those of you born before January 2nd, 1954 can do just that, provided that you wait until your full retirement age and directly specify on your application that you want your spousal benefit only. So why would you do this? If you restrict your application to only your spousal benefit, you can receive a spousal benefit while your own benefit builds and gets delayed credits. So we're just going to look at an example of how that works. Okay, so John and Jane are both 66 years old. John's primary insurance amount, his PIA, is $2,400. Jane's PIA is $1,600. Here's what they can do to increase their Social Security benefits. Jane files for her benefit now, receiving the full $1,600 a month. John files on Jane's record for his spousal benefits and receives half of her benefit, or $800 a month. And meanwhile, his own benefit is going to grow and build delayed credits. When John turns 70, his benefits will have increased to $3,168, thanks to 4 years of an 8% annual delayed credit. So he gets half of Jane's benefit for 4 years and then switches to his own maximum benefit. If John dies, the higher benefit would transfer over to Jane and she would get rid of hers. So this is basically the best case scenario for this couple, but there's no guarantee it's going to be as neat and tidy for you. It depends on your respective age. So please make sure that you, whether or not you are eligible for something like this, or if it would work in your specific case, you want to talk to an advisor. Okay, so that takes care of what's new with Social Security. Now, as Rachel had mentioned, we would like to offer a Social Security checkup. And working with clients on Social Security and claiming strategies, we found that sometimes people miss out on benefits because they don't really know how or when to claim them. So here are a few examples. So here's a situation that's not terribly uncommon. A married person who never added on her spousal benefit after her husband filed. For example, in doing Social Security checkups, we would look to see if the lower earning spouse's benefit is significantly lower than 50% of the higher earning spouse's benefit. This could suggest that the lower earning spouse filed first and claimed her own small benefit. Then sometime later, her husband filed for his benefit. This would entitle her to a spousal benefit, which would be added onto her own small benefit. But she would have had to apply for that spousal benefit, which she didn't know to do. Our Social Security checkups help to reveal things like this. Another one is a divorced person who didn't know she could claim on a spousal benefit off of her ex-spouse. Now, not everyone can do this. It is being phased out by the Budget Act, but some people still can. And some people have more than one ex-spouse. They may be claiming off the wrong ex-spouse. So our Social Security checkups also help divorced people find out if they're receiving all the benefits they're entitled to and if they're claiming off the right spouse. Okay, here's another one. A divorced person whose ex-spouse has died. You know, sometimes ex-spouses don't always keep track of each other, but if a person was married over 10 years to an ex-spouse who has died, he or she may be able to get a survivor benefit on that ex-spouse's earnings record, which could be higher than their own. And these are not limited to women, can go both ways. Social Security is gender neutral. Divorced men can also claim benefits on an ex-wife. Okay, so if you or anyone you know would like a Social Security checkup, we might be able to help you identify some possible benefits, explore claiming strategies, and see how Social Security fits into the rest of your retirement income plan. You can call or see us after this workshop to set up an appointment. Okay, so this concludes our first Food and Finance webinar for the Social Security, What's New with Social Security series. As Rachel had mentioned, we are going to have one next Friday that will build on the Social Security claiming strategies for spouses so that you can understand those more deeply. And then we are always open to suggestions for what you would like to hear during the Food and Finance presentations. Big key takeaway here is Social Security is way too important for guesswork. So let us help you protect your nest egg and maximize your income in retirement. And then we're just gonna go ahead and open it up for questions.